Ladies and gentlemen, my name is Andrew Stotts from the Valuation Masterclass Bootcamp, and today I'm here with one of my excellent students, Pitipong. Pitipong, are you ready to go?
Oh, absolutely, I am.
Yeah, I'm excited to see what you got. Now, hold on one second. I'm just going to pull this up for just a second. For those people who are thinking about building a competitive advantage in company valuation like Pitipong has been building, make sure you join us in the next Valuation Masterclass Bootcamp, which starts in 52 days. Scan the QR code or go to the link and use that code BC22 Live, and you'll get $1,900 discount right now. Incredible. All right, I think you're gonna have to share your screen again. Let's see.
There we go.
Okay.
But,
all right, that's great. It looks good, and I think we're ready to go. So I'm gonna leave, and then you start. Ready?
All right.
Go.
All right. Well, as introduced before, my name is Pitipong Wanta, and currently, well, today to be exact, I'll be initiating coverage on Microsoft with a sell recommendation based on a target price of $365, implying a whopping downside of 28%, which I derived my target price from a DCF valuation using a WAV of 12%, a terminal growth rate of 4%. So the three main highlights for Microsoft today is its AI ubiquity and cloud scale, which are the two main factors driving Microsoft's business right now. The second being technology markets, which are still offering a steady double-digit growth opportunities, not just for Microsoft, but for its competitors as well. And the concerning rise of bureaucratic oversight, especially from the EU, and the recent integration of the federal government and Microsoft through its recent contracts and the leading carbon removal initiatives taken by Microsoft. So its risks include that Microsoft's inherent sensitivity to swings of AI and cloud markets, its potential over-intensification on capital and the market pressures as a result, regulatory and antitrust scrutiny, and environmental and ESG execution. So, for a quick background, Microsoft was founded in 1975. It is a multinational technology corporation from America, and it reported a recent revenue of $281 billion, with over half coming from the United States, with 49% coming from international sales. Its business is split into three segments: productivity and business processes like Microsoft 365, such as Excel, PowerPoint; intelligent cloud, it's Azure software; and the more personal computing, which are the physical products. So it's quite a large company. It runs 70 plus Azure regions and 400 plus data centers globally, which holds a market leading position in the enterprise productivity software. And it holds a second place share in cloud infrastructure, second only to Amazon, and ranking among the top three in gaming following its acquisition of Activision Blizzard. And it's expected to invest tens of billions into AI-focused data centers, custom silicon, and Copilot PCs to reinforce its market leadership. Now, recently, Microsoft has taken a very aggressive AI-first strategy across all of its domains, specifically in the productivity and business processes, which through its partnership with OpenAI, it tries to monetize Copilot at scale, lifting productivity growth toward the mid-years CAGR through 2030, and its sizable growth in Azure underscores the share gains that it's making in the cloud market, expanding at 18% CAGR, suggesting that Microsoft could definitely close the gap somewhat with Amazon's 31% share, although I wouldn't be too optimistic about it. While its $65 billion annual capex recently on AI data centers and custom silicon, it is set to double capacity by 2030, sustaining both cloud and AI leadership. All the while, its acquisition of Activision Blizzard and Copilot Plus PCs create recurring consumer revenue streams and a new hardware cycle. So together, these moves imply a sustainable double-digit top-line growth for Microsoft, although ROIC, as a result of accelerated capex, will fall as projected by me from 41% to 23% as capital intensity rises. Now, taking a look at the market itself, Microsoft's markets that the markets that it specifically serves, it remains quite healthy, but it isn't overheated just yet. It has 15% CAGR on productivity software, 18% in cloud, and 7 to 9% in gaming to 2030, according to Grandview Research. Now, Azure continues to outpace peers, growing at 1.5 to 2 times the pace of Amazon's web service, with management aiming for $100 billion. I think I've made a little typo there, but it will aim for $100 billion annualized Azure by 2028. Now, LinkedIn has surpassed 1 billion members with strong ad momentum. GitHub Copilot crossed 1.3 million paid users, and Windows maintains a 72% desktop OS share. Now, Xbox, it now ranks at number 2 in global gaming revenue, with AI-powered Bing and Edge slowly clawing back search and ad share, but not too much. So this breadth ensures that Microsoft could sustain a modest yet sizable 13.5% total revenue CAGR through 2030. Now, as for the recent developments, in 2025, Microsoft has also secured a landmark contract with the United States federal government. So it embeds Copilot, Azure, and Dynamics into the government information technology, with savings for the government itself. So it can ensure a steady demand and channel revenue from the US government. While on ESG side, it purchased approximately 80% of tech carbon removal credits in 2025. So it is investing and pretty much integrating itself into the overall green economy ecosystem. Although regulators have also been circling the firm, as the UK's authority that overseas monopolies and antitrust has also flagged Microsoft and Amazon 70% UK's cloud share, and the EU is considering a strategic market status label, which could limit bundling and potential expansion into into markets by Microsoft. And the US FTC is still monitoring Microsoft's recent integration and acquisition of Activision. So, in conclusion, Microsoft has been making overtures to improve its ESG profile, although there has been some regulatory red flags. So, as for its quarter-to-quarter growth recently, its revenue has been steadily growing at 18.1% year on year. There has been a slight drop in the first quarter, although it has recovered quite significantly. So revenue right up to fiscal year 2025 has grew to $76.4 billion, with gross profit up by 16% and operating profit increasing by 23%. Now, net income also came at a very sizable 27 billion, up by 5 billion from last year, reflecting resilience in margins despite its heavy capex. And as for operating margins, it has also improved, and the recurring EPS stood at a strong $3.65 per share, a 23% year-on-year growth. So latest news is just to remind you that Microsoft secured a steady channel of revenue with the government, has announced a quarterly cloud revenue of 24.3 billion, with Azure growing 34% year on year, maintaining its second global cloud share, and it is currently ramping up data center investments, with capex projected to exceed around 140 billion by the year 2030, which could affect its ROIC. Now, as for constraints to growth, Microsoft as for capital, it currently operates with a sizable net cash balance of 95 billion, projected to rise to 273 billion by the year 2030, and it also has very low levels of debt, initially at 3.5% in 2025, although it's going to grow to 10%. Its Cash conversion cycle has also been historically low and even negative. In 2025, it was only negative 36.4 days, and is projected to remain so. So, in terms of capital, financing isn't necessarily a barrier for Microsoft, but high capital expenditures do make efficiency the real constraint. Now, as for operations, Microsoft's scale is quite unmatched, but emissions have surged and hardware supply, notably NVIDIA GPUs, remains a bit of a bottleneck. So there has been recent initiatives such as its in-house chips, such as Cobalt, which aims to reduce external dependency, although execution and sustainability risk could persist. So supply chain resilience from sourcing advanced chips to securing renewable energy, which is to keep Microsoft in line with its ESG promises, will be critical to expansion and is currently being pursued. So, but I do not put too much of a issue on that because so far it is quite a stabilized thing and it's not really big of problems. But as for the market, Microsoft's three revenue pillars, it addresses basically in markets it is growing in terms of productivity software. It has high CAGR for now through 2030, and it has mid single digits CAGR on gaming. Now growth is quite ample, but it's not infinite. Now Azure has already hold uh 20 to 23% global shares, second only to Amazon Web Service. So it does leave incremental shares quite harder to capture without regulatory pushback or significant competitive pushback. And as for the human capital or the people part, Microsoft employs approximately 220,000 people worldwide with deep technical talent and long tenured leadership under Mr. Satya Nadella. Now, succession risk is limited given the company's broad executive bench and established governance structures, although there's a lot of dependence on Mr. Nadella's AI first strategy. So, if anything were to happen, such as a resignation, it would be quite catastrophic. So, the main issue with the people it just rests upon the global talent war for AI engineers, so that may push costs and and potential retentions and potential issues in trying to retain these human capital. So it could be a moderate, but it is still a manageable risk. Now, as for the revenue breakdown, so Microsoft's revenue is derived mostly from its three operating segments: the productivity and business processes, the intelligent cloud, and personal computing. And has reported much of its total revenue from the United States, 51%, and the rest coming from international sales, 49%. So productivity and business process, it accounts for 43% of revenue, including Microsoft Office, Dynamics 365, and LinkedIn. So it is projected to grow at 15% CAGR, supported mainly by AI monetization through Copilot and accelerating LinkedIn subscriptions. Intelligent Cloud contributes 38%, such as Azure server products and enterprise service. Now, this is the main growth engine for Microsoft, as it will be projected to grow at nearly 18% CAGR, supported by global cloud adoption and custom AI infrastructure. And for the rest, it is made up by personal computing segments such as Windows licensing, devices, gaming, and it makes up 19%, and it is expected to expand at a modest 6.2% CAGR. Now, as for the four elements, Microsoft overall it remains neutrally attractive, slightly below. So let's get into that specifically. Now, it has considerable profitability and a decent balance sheet. So in terms of fundamentals, it is average at 46%. It's average at 46% operating margin and 36% net margin. Although return on equity has eased from 47% in 2021 down only to 33% as of the current date. So I think it's mostly because of the falling asset efficiency as a result of its increasing capex. As for valuation, it is quite unattractive, trading at a premium of at a very large premium of 37 multiple PE and 11 times PB. So in terms of enterprise value to EBIT has expanded to 29, and the price to earnings growth has increased up to 2.3, which highlights a very steep price that investors are paying for expected AI led growth. But for momentum, it still remains quite decent, although revenue growth has slowed to 15% from the pandemic highs, while the EPS has remained strong at 16%. So the risk is slightly better as Microsoft does have a sizable net cash reserves. Liquidity is signed at 1.4, and interest cover is still quite high at 50. And beta has dropped to 0. 0.9 as of recently, showing that it is quite volatile, but it's still catching, and it is still acceptable in terms of relative to the market, to be exact. As for profitable growth, Microsoft across all the board, it is ranked number one every year since 2021, placing it at the top of global info tech peers with unmatched stability. So it has held profitability, has held at the first place throughout, backed by approximately 70% gross margins with more than 40% operating margins. So it is definitely a cash flow machine. But as for growth, it has improved somewhat from 6 to 4, but it's driven mostly by Azure and Microsoft packages. So it is somewhat offset by weaker personal computing markets. As for asset efficiency, now this is the Achilles heel of Microsoft. It has stayed weak at number 8 since 2021. Although expense control could definitely pump that image up a little bit because it has consistently ranked at number 1. So it does highlight a very good cost discipline from Microsoft. As for revenue growth, it has swung from number 5 in 2021 to the second place in 2023 before easing down, normalizing at down to number 3 again at in 2025 or PTM. While expense direction has improved somewhat, so it is still quite considerable, but not exactly a shooting star in that direction. As for global benchmarking profitability, just as I mentioned, it's just amazing. From 2021 ranking, even though it may have decreased a little bit from 20% down to 18%, but it's still better than its peers, to be exact. But for growth, it is quite average, but it's quite average with slight variation, but it is still improving somewhat. But as for asset utilization, this has been stable near the bottom throughout. And net margin, it is also stable, but it is at world-class level. And as for sales growth, it has improved quite a lot, but it's still volatile. And as for net margin change, it has improved as well, but also as volatile. As for environmental score, Microsoft pretty much, well, it is pretty much almost a pristine company with a few caveats. So, does it have a research reduction policy? Of course, it does, according to its Our Sustainability Journey web documentation on its website. So, it's committed to being carbon negative by 2030, water positive, and zero waste by 2030 as well. Has it faced any environmental controversies? None has been found so far. Does the company have any emission waste policy? Of course, they do. It is in their environmental sustainability report. Has it engaged in emissions trading? Just as I said, it does use internal carbon fee and contracts large-scale carbon removal credits. And does it have any environmental eco, green, or organic products? Of course it does. It offers Microsoft Cloud for sustainability and related solutions to reduce customers' footprints. It has been doing this since I'm pretty sure like 5-10 years ago, if I could remember correctly. As for social, it is clean across all the board. Does it have any health and safety policy? Of course it does. It's in their trust code. Human rights policy, it's in their global human rights statement as published, which guides their operations and supply chain. Does it have a fair competition policy? Of course they do. In the commitment to anti-corruption and anti-bribery, which pertains to its prohibition of corrupt payments of all kinds. Does it implement quality management systems? Of course it does. In Microsoft Azure Dynamics 365 and Microsoft's own 365, it holds an ISO 901-2015 certification. Does the company derive any revenue from weapons, alcohol, gambling, tobacco, and pornography? Of course it doesn't. It mostly derives from its software, cloud services, devices, and gaming. None of that uncomfortable categories. As for governance, well, this is a bit more of a issue for Microsoft. So, first off, does the company have board independence in line with or above the country average? Yes. 11 out of 12 directors are independent. Committees are also independent, and there's a lead independent director as per governance fact sheet. So making it in line with America's average 85%, as noted by Spencer Stewart. Does the company's chairman also act as CEO? Yes. unfortunately. Mr. Satya Nadella is both this chairman and CEO of Microsoft since 2014. Does the company have any shareholder rights policy? Yes, it is in its corporate governance on the company website. Has the company faced any insider dealing or accounting controversies? Unfortunately, it has. So it has faced recent incidents of insider trading, such as the 2013 Jorgensen stock case, and it has also been charged by the SEC a couple times regarding accounting violations from 1990s to the 2000s. So, and does the company have any corporate social responsibility, sustainability, or ESG reporting? Yes. As mentioned, it's in the sustainability report, TCFD, verification statements, which are all available in its reports hub. And as for the profit and loss statement, now Microsoft, I forecast that it will grow at a sustainable 13.5% CAGR. It will almost double its revenue by 2030, with its net profit also almost doubling as well. And as for its assets, this is where the capex really kicks in, because Microsoft will grow its net fixed assets by 200%, which is the concern that I have about its capital over intensification. As for its total liabilities, now Microsoft doesn't necessarily depend too much on long-term debt, just mostly current liabilities to fund any cash deficits, with much of its capital still coming from retained earnings. As for capex, now this is where I basically highlighted the potential over intensification of Microsoft, because by 2030, it would have spent twice its capex in 2025. So that is something they should be watching out as well. Uh, as for the ratios, everything will pretty much remain decent throughout. Nothing really changes too much. It will maintain its current ratio, its cash conversion cycle, including its inventory conversion period, receivables, etc., 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 including even its gross margin EBIT will remain as such. As for the revenue for now, this is the revenue forecast. I made the growth assumptions. So I gave Microsoft a quick 15% in 2026 as a sort of optimistic premium, just in case there was some new exciting innovation technology that or market they have to happen to exploit. But in the end, I believe that it will eventually normalize back to 13.5%, with its revenue on equities slightly decreasing down to 26.7%. And as for its free cash flow data, uh, for the free cash flow to firm, it will also almost double. I wouldn't say almost double. It does, but it does increase quite significant, about 70 to 80%, from 118,000 dollars in 2025 to $194,000 in by 2030. So that is a lot of cash available for the firm. So with equities also catching up as well. Now, as for relative valuation, on the forward 2026 PB basis, Microsoft trades at 9 times, which is, sorry, hold on, trades at 9. Okay, yeah, 9 times, which is below the US 9.7, but it is still above the world's 6.9 and Asia's 2.6, which indicates that the stock remains at a premium valuation globally, but not exactly relative to the US peers. But for the return equity figures, it is projected to grow at to be around 30.6% at 2026, which is higher than the world's 27% and Asia's, excluding Japan, 17%, but it's still slightly below the American 34.7%. So, despite its strong profitability, the stock is trading at a PB to ROE ratio of 0.29, which signals that it is quite overvalued versus its peers, and thus investors are paying more per unit of return. As for the P to growth, Microsoft trades at 32.4, which is a premium to its peers in the US, the world, and Japan, the whole 9 yard, which just suggests that Microsoft is it's just trading richly value relative to the global tech sector. Now, as for the EPS, it does moderate over time, which is projected at 14.8% at 2026, lower than the benchmark, even lower than the Americans, the Asia, and the world markets. Now, uh, as for the fundamental valuation, I assume a risk-free rate of 2.5%, given that the current interest rate might fall a little bit, and a market equity risk premium for the US market of 10%. Now, Microsoft has historically been a moderate beta stock, but I assume a little bit of sensitivity with a beta of 1.1, which is slightly higher than its previous averages, resulting in a cost of equity of 13%. Now, I forecast that the capital structure will be around 7.9% debt to total capital, so it will result in a WACC of 12.2%. So I use a rather high terminal growth rate of 4% uh, for the for the fade period. Just making sure to be a little bit optimistic, although not too optimistic for its potential high growth into the future. And I pretty much use free cash flow to the equity as a basis for my valuation. So in my base case scenario, I just anticipate a gross margin of 69.4%, which leads to a value of $365 per share based on my FCFE methodology, which represents a 28% downside compared to the current market price. As for sensitivity analysis, in my optimistic case, I will assume a 71.4%, which results in target price of $373. Now, conversely, in a pessimistic case, I assume for a 67.4% gross margin, which is 2% below the base case, and it will fall, and the FCFE will fall down to $358.4. So it is somewhat sensitive to the gross margin changes. Now, as for the risks, like I mentioned earlier, Microsoft is quite sensitive to swings of AI and cloud markets. Its growth trajectory is mainly tied to AI and cloud adoption. So any slowdown in enterprise AI spending or weaker than expected monetization as Copilot or cloud workload migration to competitors, it will materially impact its top line growth. Given that Azure and Microsoft 365 are the primary engines of their expansion. And next is the capital over intensification and margin pressures. Now AI and data center investment, it has set to exceed $80 billion to $130 billion per year. So it would drive invested capital up by a few multiples by the year 2030. While this supports growth, it does compress its ROIC significantly from 41% down to 23%. So it creates a risk that if returns lag behind spending, uh, it would it would definitely make its ROIC figure even worse than it should be. So sustained high capital intensity could cap margin expansion and reduce its flexibility to allocate cash elsewhere. Next up is regulatory and antitrust scrutiny. So recently, the British government has flagged its joint dominance in cloud markets with Amazon. So that would definitely limit its market expansion in the British sector. While the EU has also been weighing in the decision to label Microsoft as a strategic market status, which is very restrictive to its bundling and licensing practices. Now, in the US, the Federal Trade Commission is still monitoring its integration with Activision. So, heightened oversight risk, fines, remedies, or limits are also expansion on both cloud and gaming markets for Microsoft. And next up is the environmental and ESG execution. So, funnily enough, despite its pledge to be carbon negative by 2030, Microsoft emissions have risen due to AI and data center energy use. So it has become a largest buyer of carbon removal credits, 80% of tech purchase in 2025. So if sustainability targets are missed, the company will risk significant reputational damage, higher compliance costs, and ESG investor backlash. So even more negative pressure on its already fragile stock price. So concentration in improving carbon removal technologies does further heighten the execution risk for that part as well. All right, thank you.
All right. So let's Moment has a question, which is given all the positive things, you know, you've mentioned, what is one thing that would make you say it's a solid sell? Because, you can look at a lot of things that you talked about. There's a lot of positive things going on.
Well, I think the main I think that the main point that I'm trying to make, if I mean, sure, yes, I did make a very positive case for Microsoft, but I think the main point is that the market that Microsoft is situated in has, I mean, does it have single digit, two-digit growth at 13.5%? Of course it does, but is it really that expansionary? I don't think so. It is very, very limited, and plus, it still has competitors, and the regulatory oversight could limit its growth significantly. So I
Mm.
wouldn't say that it is a shooting star, but it is definitely trying to catch up still.
Okay. And another question coming from Roman's a little bit more technical. Why does Microsoft still rent GPUs from other companies, although it designs its own AI chips? What do you know about that?
Why does Microsoft still rent GPUs from other companies' other designs? I think it's because, well, Microsoft has historically, it hasn't really depended too much on in-house manufacturing. It mostly just designs its own chips and whatnot. But I think that, after all, Microsoft historically it has pretty much contracted its manufacturing elsewhere. So renting GPUs to other companies, or it designs its own chips, but it contracts manufacturing. So I'm not sure exactly what that question means. But
Okay.
no, but
Let's keep
yeah.
going.
So.
Another one from Moment is, do you expect a shift in revenue from productivity to cloud, and which has better margin?
Oh, I wouldn't say exactly, because Microsoft's 365 is productivity. It's still a mode. It's still a competitive mode. It's still a huge part of their business. While cloud is more cloud and AI technology, everything that has been doing so far, it is still a relatively new market. So I don't think it's going to shift that significantly just yet.
So how does it feel to complete this project?
As you can tell, I'm sweating very hard right
Yeah.
now. That's all. I'm just anxious, and I've got to turn on the fan as well. So, but it's been quite a very contributing journey. I've learned quite a lot. It's just, you know, like you said, just like, if you really want it, you better fight like hell to get it. And I'm basically fighting like hell to get it right now. And it's been quite a journey, but I would say it's pretty much worth it so
And how
far.
would you compare yourself today in what you've just produced to where you were on day 0 or day 1 when you started the boot camp?
Oh my God. Like, in terms of the theory aspect, I've learned a lot about finance, but haven't really put too much into the practice. So, especially PowerPoint presentation and live and presenting on live, I would say it's not the best that I can do right now. It's not my optimal, but it's definitely better than me having no experience at all. And despite me being anxious, I'm actually quite proud of doing this.
Yeah.
I mean, the fact I can do this is just, it's just amazing. I never thought that I could last this far, but I guess I am now. And thanks to you, Mr. Stotts.
Yeah. Well done. I mean, as you know, a lot of people aren't making it to the end,
Yeah.
but you are doing it. So I want to congratulate you on that. So keep up the good work. You're absorbing all the stuff that we have to teach. And this is part of the reason why I've also extended the boot camp to 12 weeks, because I just know we have so much more that we can teach, in 12 weeks than what we could in 6. And you are an example of that, happening. So well done. All right. I'm going to take you out of this group, and then I'll see you in the Slack channel, but well done.
Thank you, Mr.
Yeah.
Stotts. I really appreciate this opportunity.
You're welcome. You're welcome. That was pretty amazing. Really another student coming from pretty much nothing and coming in and saying, I want this. I want to build a competitive advantage in company valuation. And he has dedicated himself over the last 8 weeks, shows up at every live session, asks great questions, and is learning. If you want to build a competitive advantage in company valuation, just like Pitipong has, join us at the next Valuation Masterclass Bootcamp, which starts in 52 days. You can get a $1,900 discount now. This only lasts 7 days. Just use the coupon code BC22Live at checkout. You can reach it at valuationmasterclass.com/bootcamp or scan the QR code. My name is Andrew Stotts, and I want to challenge you to build a